Hey, this is Matt from Universal CPA Review. We're about to walk through 5 example adjusting journal entry questions that you could see something similar to on the far section of the CPA exam. Adjusting journal entries are extremely important. They're difficult because you have to be able to interpret how certain transactions or events are ultimately reflected into the financial statements for a specific period of time. So really focus on these questions. Always be thinking about what is the journal entry, and you'll be a pro when it comes to taking the FAR exam. Are you ready? So in this question, we have NFT partners, and guess what? They're getting caught up in the NFT craze. Maybe they bought an NFT of the CPA exam. I don't know what that would look like, but it might be worth some money someday. Now, ultimately, we need to figure out what NFT would report as their prepaid expense balance at the end of December 31st, year one, right? And we're going to have two components here. One relates to insurance and the other relates to real estate taxes. So let's start with the insurance premium. So it says they paid $72,000 annually and the payment was made on July 1st, right? It covers the period of July 1st, year one, to June 30th, year two. Well, guess what? That's full 12 months, and our cutoff date or period end date is December 31st, year one. So 6 months of that premium payment actually relates to year two, and that would be a prepaid expense balance on the balance sheet. And so we can figure that out by taking the total cost of the insurance plan, which was $72,000, divided by the number of months covered, which is 12, and that means insurance is $6,000 per month. Now, if we need to defer 6 months, right, the period from January 1st, year two to June 30th, year two, then we would just multiply 6,000 times 6 months, and that means our total prepaid balance at December 31st, year one is 36,000, right? Because 6 months of that has already been recognized in year one. We need to defer the remaining 6 months. The concept is very much the same for real estate taxes. So here it says they paid $24,000 of real estate taxes to cover the period from October 1st, year one, to September 30th, year two, right? So again, another 12 months, except this time the portion of year one, right, is only 3 months, meaning 9 months need to be deferred. So we'll take real estate taxes paid of $24,000, divide by the number of months covered, which is 12, and that means real estate taxes per month are $2,000. Now, if we need to defer 9 months, right, that period from January 1st of year two to September 30th, year two, we just multiply 2,000 by 9, and that means our total prepayment at December 31st, year one for real estate would be $18,000. So now that we have the individual balances at December 31st, year one for both insurance and real estate taxes, well, we need to add this together because it's talking about total prepaid expenses. So 36,000 plus 18,000, that means our total prepaid balance on the balance sheet at December 31st, year one would be 54,000. So that's the correct answer. Now, we don't necessarily have enough information to know exactly what the adjusting journal entry is. If we assume that when they made those premium payments for both real estate taxes and insurance, that they were fully in cash, and then at the end of the year, we just need to make an adjusting entry to record the proper prepaid and remove some of the expense that actually relates to year two, then the journal entry is pretty simple, right? We would just debit prepaid insurance and prepaid real estate for the respective balances, and then we would credit insurance expense and real estate tax expense because we need to remove some of the expense from year one because it's being deferred until year two, right? So a credit reduces the amount of expense in our financial statements. Now, there's no impact to cash because the cash has already been paid, right? That's the whole idea when it comes to a prepaid expense balance, right? So again, it was just asking for the prepaid balance, and the correct answer there was $54,000. So we've got Sampson Legal Firm, and they provided legal support during year three to NIO Technology. Now, they had a trademark dispute with a competitor. That shit happens all the time. So basically what NIO needs to do is, if they haven't received an invoice from Sampson for legal services during year three, well, they would make an estimate until they actually receive that invoice from Samson. And so NIO had an accrual as of December 31st, year 3 for $125,000, right? That's what they believe to be the best estimate for legal fees related to Samsung, and that was based off the original quote. Now, most law firms, they don't necessarily stick by their original quote because they bill on an hourly basis, right? And we all know they jack up the rate for that. And so what NIO needs to do is figure out, okay, what is the actual amount? And on January 10th, year 4, they received that invoice, which says that actually legal fees for year 3 were $95,000. So before they had their best estimate, but now they have the actual invoice, and that's what they should adjust their financial statements to. So we'll need to figure out what the adjusting entry should be. So first we need to figure out the required adjustment. So if the actual year 3 legal fees were $95,000, but they currently have $125,000 in their financial statements, then the required adjustment is a negative $30,000, meaning we need to reduce the amount of legal fees by $30,000. And so if that's also an accrual on the balance sheet, right, because they don't have the invoice yet, so they couldn't have paid, we also need to reduce the accrual. And so to reduce the accrual and legal fees, we would debit accrued legal fees for $30,000 and credit legal fees for $30,000, right? That credit to an expense, that reduces it, that basically pulls the expense out. It increases net income and profitability. So for the company's financial team, they're loving this because all of a sudden now net income is $30,000 higher because they overestimated how much they owed to those lawyers, right? So again, make sure you know the journal entry for this type of situation. So we're at the end of the year and Green Industries is preparing their year 5 financial statements. And as you're probably aware, right, the company performed a physical inventory count on the last day of the year, right? So they shut down all the operations. The whole warehousing team was out there counting inventory. And the auditors were also there performing their own test counts. Now we need to determine, does an adjustment need to be made to the inventory balance on the company's balance sheet? And based on the information in the question, well, inventory on hand per the perpetual listing was $125,000, but Green and its auditors determined the correct balance is $150,000 based on their count, right? So actually they need to increase inventory by $25,000. So what's the adjusting journal entry? Well, if we need to increase inventory, we will debit inventory for $25,000, right? That increases that account. So what is the offsetting credit? Well, it's probably going to be to cost of goods sold for $25,000. It's going to reduce the amount of expense in the company's income statement, right? Because they actually have more inventory on hand than they had thought, meaning they previously overexpensed cost of goods sold. So the correct answer is going to be debit inventory for $25,000 and credit cost of goods sold for $25,000. So Sift Electric received 4 invoices for social media advertising in year 5. However, those related to social media campaigns that ran in year 4, right? So when should the expense be recognized? Well, when the service was performed, right? Or when those social media campaigns were run. So that means all 4 invoices should relate to year 4. Now, where some candidates get tripped up, they look at it and say, well, okay, I get it because the date for 3 of them is in year 4, but one of them is year 5. And the thing is, it doesn't matter when it's dated, when it's received, it just matters when the service was incurred, right? Or the expense should be incurred. And that would be in year 4 because that's when those social media campaigns were run, right? So all of these were unrecorded invoices, meaning the company should have recorded them as of 12/31 year 4, but they didn't. So they'll need to record an adjusting journal entry to make sure all 4 of those invoices are properly captured in the financial statements. So the 4 invoices total to $55,000 of expense. And what we need to do is first figure out, okay, how do we record that expense? Well, it's a debit to advertising expense for $55,000. Now, since these invoices were unrecorded, they obviously weren't paid yet. And so as of 12/31 year 4, they also need to record the liability for those invoices, which hopefully they pay in year 5, right? So we'll go ahead and assume those are recorded to accounts payable because that's the only liability account that is in this question, right? It could also be accrued expenses, but we'll assume accounts payable, right? So it would be a credit to accounts payable for $55,000. So that means the correct answer here is debit advertising expense for $55,000 and credit accounts payable for $55,000. And again, just remember, under the matching principle, we recognize the expense when the service is performed by the vendor, right? In this case would be the social media campaigns. So Stroud Packaging sells packing supplies to customers located all throughout the US. And they do have a return policy. They allow customers to return items within 30 days, right? So same as when you buy something off Amazon, you have 30 days to return that item. Now, ultimately, we need to figure out what adjusting entry the company should record for a change in their sales returns reserve. So before we get into the entry, let's make sure we understand why a company has a sales returns reserve. Well, let's say that a company sells $100, right, to 100 different customers. Well, if they have a return policy, then based on historical data, right, they know that some percentage of those people are going to return, right? Similar to how when you buy things off Amazon, well, some percentage of your purchases you'll likely return. And a company has to maintain a reserve so that their gross to net revenue is properly stated, right? Because again, they know that certain customers will return some of the sales items that they purchased. And in this question, it basically says that currently the sales returns reserve is $125,000. But based on a recent spike in sales, the company's CEO thinks that should be up to $135,000. So ultimately, the CEO is saying we need to increase our sales returns reserve by $10,000. Well, the sales returns reserve is a liability account on the company's balance sheet. So if we need to increase a liability account, we will credit that account. And the offsetting debit will be to revenue, right? Because we need to state revenue as net revenue. So the correct answer here is going to be debit revenue for $10,000 and credit sales returns reserve for $10,000 as well.